Hi traders, and welcome to my video on the Multi Timeframe Trend Indicator. In this video I'm going to show you a simple strategy that you can use to help you capture moves like this one for over 650 pips and counting. So for the multiple time frame indicator, we're using the moving average multiple time frame trend indicator. Okay, this is a euro dollar 1 hour chart. I got the indicator for free online. You can change the periods to use for the moving averages here. So you can see that I've selected the 1 hour, 4 hour, and daily. You have your options there. Current time frame, 1 minute, 5 minute, 15 minute, 30 minute, 1 hour, 4 hour, 1 day, 1 week, 1 month. Okay, so I'm going to use the 1 hour, 4 hour, and daily because I'm just looking at the overall long-term price, as well as the price of the chart that I'm trading, which is the 1 hour chart. I like to trade higher term chart time frames simply because they contain more price data, and therefore I find the signals tend to be much more reliable. But if you want to trade the 5 minute, 15 minute charts, you can always set the multiple trend indicator to look at the moving average on the 1 hour, the 4 hour, and the daily, just to confirm the direction you're going to trade in. So the purpose of this indicator for me is just to only trade in the direction of the trend across the multiple time frames. Okay, so basically when price is below them all, okay, or they're lined up nicely like this, so the blue being the daily, okay, the green being the 4 hour, and the red being the current hour, which is 1 hour, or in that particular order, I'm going to look to sell if it's blue, green, red, okay, and if it's in a downwards direction, and if it's blue, green, red in an upwards direction, we're going to look to buy. Okay, it's not just as simple as when they cross, we buy or sell. Okay, we're going to need to time our entry as well. So how I would do that is I just wait for the indicators to line up. So you can see that was here. Okay, once the green had crossed the blue here, we had the blue, green, and red. And that doesn't mean we sell straight away, because if you do that, you're going to be selling at the bottom of this move here, which you don't want to do. You don't want to sell at the low. So instead, we wait for a pullback. Okay, and we get a pullback here. Okay, see that there? Nice downwards move. Market's making these lower highs. We get our pullback. We have our M pattern. See that M, letter M there, and a breakout to the downside. And we could have entered here, knowing that with confidence we're trading in line with the overall trend, which is down on the daily, down on the 4 hour, and down on the 1 hour. Okay. Reason I wouldn't use weekly and monthly, well, you could, but you would find that maybe the monthly may not agree until down here somewhere, and you could you could miss, like, part of the initial part of the move. Okay, because it can be lagging depending on the chart time frame that you're using. Okay, so we can enter there, and what I would do is I'd place my stop loss here just above the high. So we're looking at around 10 pips, which is really tight from the 1 hour chart time frame. Okay, and if we zoom out, we can see huge profit potential on this trade. Whilst it's over 500 pips down to there, what I would have done is I would have used a trailing stop. Okay, so with a trailing stop, first I'll move the stop loss to break even. So when price drops around here, I just probably lock the trade in at break even as early as possible. And just use a trailing stop above the high, above the high, above the high, just moving the stop loss above the highs all the way down to lock in as much profit as possible, probably down to here. And then when price turns around and we get taken out, we've made over 250 pips with a really tight stop loss. So it's a great trade, and we can always look to re-enter again once these line up. You can close part of the position on the way down as well if you want, just to bank some pips and let the rest run. Certainly what I wouldn't want to do is have a tight stop loss. Say we've got that 10 pip stop loss, price drops down to here 50 pips, it's still a good trade, but if we exit here, we just leave way too much profit on the table. You can of course re-enter, okay, provided all the moving averages agree across the multiple time frames, so they still all agree to sell. We can look to trade a breakout there. That's a non-farms payroll NFP first Friday of the month candle there, just causing lots of momentum to the downside. Could have hopped in on that. Again, level of support there, holds up well, breaks out, support becomes resistance. You can trade there. You can still get in on the trend there, but ideally you want to get in as early as possible. Although there are opportunities throughout, whether there or there, to enter into the trend. Okay. But what you don't want to do is you don't want to sell too low. You want to try and get in early as possible. Support, breakout. So in essence, what you're doing is you're trading in the direction of the moving averages, short in this instance, because they're all heading down on multiple time frames, you know, the 1 hour, 4 hour daily. So we know the overall picture is short or selling trades. The trend is your friend. By trading in the direction of the trend, I feel like you can increase your chances of being on the right side of the market. And that way, and with good money management, you know, cutting losing trades short, letting winning trades run, having good trade disciplines, don't let negative emotions like fear, anger, and greed get in the way, or revenge trading, FOMO, fear of missing out, so on and so forth. We can capture some big moves and be up overall. Okay. Again, overall picture here in this market is downwards. So blue, green, red, pullback. You get the pullback here, and then you can just trade a breakout of the support there. Okay, so this nice level of support holds up. M pattern formation, breakout to the downside. No coincidence, there's a big breakout candle there. Okay, market's making lower highs. Yeah, they all line up, blue, green, red. The overall picture is bearish. Okay, so we can just time our entry on breakouts, pullback, breakout, pullback, breakout. But you wouldn't necessarily need to take all of these trades. You can just take one, get yourself in a good position, and just maximize it as much as possible. Okay, so if we just go back and look for a long example, principle's the same. Once they all start agreeing, so blue, green, red, this is when we're in an uptrend from around here. Okay, you wait for the pullback. That this becomes more of a consolidation, and then once you see the breakout again, you can just draw your resistance. Okay, breakout of resistance. We know we're only going to trade long because they're, you know, the daily, 4 hour, and current are all saying to trade long, are bullish. We wait for a pullback, and then you can just trade on the breakout of the pullback. Okay, so pullback here, breakout again, price pulls back here, big breakout candle there, price pulls back here, big breakout candle there. They're all agreeing nicely. We've got a clear trend. Even as far up as here, you have another pullback and a big breakout there, but be cautious. You don't want to buy at the top once you start to see these, you know, especially when you see this lower high here. Okay, all this consolidation, and then the line stopped crossing the opposite direction. But there was ample opportunity to jump in on this upwards trend by timing the entry and check in the multiple time frame trend direction. I mean, by staying on the right side of the trend, you can increase your chances of having a successful trade, in my opinion. It doesn't mean that will always be the case. You can see, if we just look, I mean, you probably wouldn't trade in this anyway just because it's so choppy, but if you insisted and you saw this move down here, be like the red's below the green's below the blue, fantastic, I'm going to sell. You don't sell there. What you do is you draw your support and you wait for a breakout. And then you can see that didn't happen, so that would have kept us out of trouble instead of just jumping in straight away there, yeah? Or if you had gone early and perhaps you entered here, well, they hadn't all lined, but aligned anyway, but if for argument's sake you did sell there, worst case scenario, you should be break even there. When price fell down here or started to creep back up, you could have locked the trade in and break even. Don't let a winning trade turn into a losing one. Okay, and protected yourself. If you just left your stop loss up here somewhere, it would have been taken out. Okay, especially with this bear trap you see here, traders trying to sell into this this move here, and then they're just getting a stop losses taken out. Traders that were in early up here are taking profit, and then it just causes the shift of momentum to the upside. Okay. About this as well, there are instances where it will be lagging. You see a nice trade example there. Okay. all in upwards direction, pullback breakout. When they will be lagging here, okay, some traders would argue in this scenario, you've got your resistance, okay, got your lower highs, okay. Some traders may be looking to short here, you know, whether they're just going to go based off of a breach of that trend line there, okay, or they're going to use the support in there, lower highs, wedge formation, breakout to the downside. Okay, you got an inside bar or engulfing bar there. You've got 3 inside down candlestick pattern, lots of bearish price action here. Some traders may have taken this aggressively, but you can see these didn't all agree. The multiple time frame analysis, yeah, you know, you were far away from, we're actually above the daily moving average, but you know, it still arguably was a good trade. You know, you could have been in here on this breakout over 100 pips, okay. But generally speaking, if you wait for a scenario where they're all aligned, you can increase your chances of being on the right side of the market. Not all the time. When conditions are choppy like this, you might just want to stay out of trouble. But when you see a nice, clear and obvious, you know, alignment like this and a move in a particular direction, there's going to be ample opportunity to bank plenty of pips. And with good money management, you know, cut and losing trades short, if you do get it wrong, if you do expect a breakout in a particular direction and it doesn't work out, you know, you can lose 20 pips 5 times in a row, you're down 100 pips, but you capture a move like this for 400 or 500 pips, you can make back those losing trades and some more. Okay, hopefully you found something useful in this video. If you can like and subscribe, that would be great, and I hope to catch you on the next one. Take care.